Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. My name is Devi Nur Fajrangrini with student ID number 234111165. On this occasion, I will be presenting learning material based on the topic assigned in the course I am currently taking. The discussion will cover important concepts that are expected to enhance our understanding and academic insight, particularly in the fields of accounting and management. I hope the explanation I deliver will be clear, easy to understand, and beneficial for all of us. Now, let's move on to the main discussion. Okay, let's start from the first slide, which is the definition of accounting for price level changes. Accounting for price level changes is a concept in accounting that discusses adjustments to financial statements due to changes in price levels in the economy, such as inflation and deflation. In changing economic conditions, the value of money is not always stable. This causes figures in financial statements, which are usually based on historical prices, to be less reflective of true economic conditions. For example, an asset purchased several years ago may have a significantly different value compared to its current value. However, in historical cost-based financial statements, that value is still recorded at its original acquisition price. Therefore, the concept of price level changes exists to adjust financial information to be more relevant, accurate, and reflect current economic conditions. Thus, users of financial reports can understand the company's financial situation more realistically, especially in economic conditions that experience significant price changes. Next, on the second slide, we discuss the objectives of accounting for price level changes. The main objective of this concept is to present financial information that better reflects the true economic value amidst changes in price levels. By adjusting for inflation or deflation, financial reports not only display historical figures, but also provide a more realistic picture of the company's current financial condition. Furthermore, this concept also aims to increase the comparability of financial reports between periods. This means that company performance from one period to another can be compared more fairly because it has been adjusted for changes in the value of money. Accounting for price level changes also helps users of financial statements such as investors and creditors in making more appropriate economic decisions, because the information presented is closer to the actual economic conditions. Thus, this concept is very important in providing more relevant and useful information for decision making. On the third slide, we will discuss the methods used in adjusting for changes in price levels. The first method is historical cost accounting, or HCA, which is a method that using the initial acquisition price without adjusting for inflation. This is the most commonly used method in traditional accounting. The second method is current cost accounting, or CCA, which is a method that values assets at current market conditions, based on current cost or replacement value. The third method is general price level accounting, or GPLA, which is a method that adjusts financial reports based on the general price index, so that changes in purchasing power of money can be taken into account. The fourth method is constant purchasing power accounting, or CPPA, which is a method that keeps the purchasing power of money constant by using the inflation index as the basis for adjustment. In addition, in practice, adjustments are also made to assets, liabilities, and equity to reflect more realistic values. The inflation index is also often used as a tool to correct values in financial reports. With these various methods, companies can choose the approach that best suits their economic conditions and reporting needs. In closing, we move on to the conclusion on the fourth slide. Accounting for price level changes is an important concept in accounting that aims to maintain the relevance and accuracy of financial information amidst price level changes in the economy. By adjusting for inflation and deflation, financial reports can provide a more realistic picture of the company's financial condition. Although in practice not all companies are required to implement this adjustment, this concept becomes very important, especially in economic conditions with high or unstable inflation rates. In addition, understanding price level changes helps users of financial reports assess company performance more fairly and rationally between periods. Ultimately, this concept plays an important role in improving the quality of accounting information and supporting more accurate, objective, and condition-based economic decision-making. Real. That concludes the material I can present on this occasion. From the discussion, we can conclude that each concept has an important role in supporting both theoretical understanding and its practical application in real-world situations. I hope this material can broaden our knowledge and serve as a useful reference in our learning process. Thank you for your attention. Wassalamu alaikum warahmatullahi wabarakatuh.